Good afternoon. Monday, Bloody Monday. I think some of us almost forgot what a sell-off looks like. This is like a little baby sell-off. Let's jump in. I am an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Here is my position disclosure. It's messy with all these options on here. I actually got added TQQQ this afternoon today, my short for the first time in months. I'm looking to relatively quickly re-enter that probably tomorrow on either sort of bounce or if it looks like there's real momentum selling coming in. But I'm anticipating that short-term tactical is going to be pretty deeply in the green tomorrow, and then I'll get an opportunity to be able to get stock back. And we're starting to get, we'll take a look at extension levels in a second. At the same time as I got out of that, on Friday, I added on a bunch more kind of covered calls to protect myself on some things a little bit. Not even really to protect myself, to be honest, just to kind of add some cash flow to a down move in the market. Let's take a look here at the daily chart technicals. We can go back to the 5 minute. I want to start with the daily. I want to see where we're at. So right now we are closing at around SPY 504.50, and we're down another 25-30 cents since the close. Right now we're at 504.25 with the ADMA at 513.50. So we've got just over $9 of downside extension now from the ADMA on the daily. That ADMA will catch up a little bit more tomorrow morning, so it's not as extreme as it looks like into the close. But if we get a decent gap down or an opening sell-off tomorrow, then we'll be coming right into that extreme extension area of $10 plus of downside extension in the market for the SPYs. That'll happen at the same time as we will almost surely have short-term tactical in the green zone, and as we are into what I think is the most important support area, which is the 503 to 505 support zone for the SPYs, which I was mentioning that as the key area to pay attention to even back as far as late February and the beginning of March. And then the market kind of continued to trend higher and create some new levels for us. So in some ways you could say this is like support level number 3. If you want to say like the Fed starting point is a support level, and then that like 510 to 508 as support level 2, which we lost today. We lost support level 2. We trade all the way down to the support level 3, which is the biggest one. So if we can get some sort of gap down tomorrow, or we can see, those headlines are no good. If we can get some sort of gap down tomorrow, or we reach that extension 10 plus in conjunction with it, that's when I'll probably be looking to go long. I'm going to put a big asterisk on that because I do want to quickly compare this market. Again, it's a different situation, but this is the closest comparison that we can do to the Russian invasion of Ukraine and what that did to the market. So let's pop back, way back in time to 2022. No, we can even start in the beginning of 2022. We'll go through like here or so, first 5 months or so. Yeah, so the beginning of this was it right here. January 24th. So what was all-time highs for almost a couple of years there is the very beginning, like the first day of January for SPYs was closing all-time highs back in 2022. And, you know, we had some opening weakness to start our year off. We created a pivot low. We bounced off that hammer here with a higher low. And it was really right in here that they were beginning to telegraph the Russian invasion of Ukraine, and that led to a pretty big sell event in front of the actual invasion. So there was just chatter about it and chatter about it, and the market was getting absolutely demolished to the point where when that invasion actually happened, everyone knew that it was going to happen. Almost kind of similar to, I almost think it was even more extreme then, but I was going to say almost kind of similar to how, unfortunately, by Friday, we knew that Iran was going to be doing some sort of attack over the weekend. They literally said it. They telegraphed it. Iran was like, "Hey, we're gonna attack Israel in some form or another, but we're gonna try to keep it like a small attack so that we don't piss people off too much and create more retaliation," which apparently might happen anyway. But it was a somewhat similar situation where by the time, and this was a Friday, and like I was warning on Friday morning last week, back in 2022 when this invasion was going on, there was a lot of geopolitical uncertainty. Fridays were very, very weak. It was like every Friday we would sell and sell and sell. And that was the exact same way here back in January 2022, where you can see this. I mean, this day we basically closed unchanged on the 14th. But outside of that, it's like one, fine, an unchanged day, 2, 3, 4, 5. This was almost like a day 5, day 6, anywhere from day 4 to day 6 down, depending on how you want to interpret January 14th here. And we closed on that Friday with everyone knowing that this invasion was going to occur, but no one wanted to keep any risk over the weekend. And then what happened? The invasion occurred, and off of that, the market had a huge gap down that day. And I remember us as a team that was it actually this day here? Am I giving us the wrong day? I'm sorry, totally giving us the wrong day. It's this day here. It was February 24th. It was the second major sell-off in this market. Sorry. Similar principle, honestly, in terms of selling, but different day by a month. So it was February 24th. But again, same principle. Day 1, day 2, day 3, day 4, we're selling down very constantly. We know exactly what's going to happen. And then on day 5, we had that massive, massive gap down, and they bought the market all the way back up because by that point, the market had fully priced in that the invasion was going to occur. The point that I'm trying to get across here more than anything is actually extension. So what we saw very consistently in pretty much all of that 2022 bear market and into 2023, in some ways on the upside, was that every single time this market became extended by more than $10, you could begin to look for that mean reversion trade. And that $10 of extension really seemed to be extreme. But the reason why I'm even going back to this example and looking at this was because I think, if my memory serves me correctly, which apparently it's a little faulty because I was just getting the wrong date here, if my memory serves me correctly, this was the most downside extension that we saw throughout the entirety of the actual bear market. So February 24th here, we opened up at 411 with the ADMA at 433.80. So we had $23 of downside extension. And normally anything above 10 in these last several years on the upside or the downside, extension away from the ADMA, has actually been a signal to go for the mean reversion trades, to come in on the other side. But I do just want to remind you that while I do think that principle is still in play, where if tomorrow we are down by more than $10 away from the ADMA on the daily, I definitely don't want to be shorting, and I probably want to be doing some buying for an oversold bounce, that in a situation where there is a lot of fear and uncertainty, that it can become significantly more extreme, just like it actually did. But this, of course, led to one of the best buying opportunities of all of 2022. And I remember that morning meeting, that's how I actually just figured out very quickly that this was the wrong day because we got bought up the second the market opened. I remember on this morning meeting when we were extended by that much, telling everyone, guys, the invasion was already priced into the market. We're extended by $23 here to the downside. It's extreme. We need to be buying as like an A+ setup to the long side on the actual confirmation of the invasion, which might on the surface of things sound almost counterintuitive. But it led to a phenomenal day. I mean, this was just a great day to be buying the second the market opened and catching this 2-day move here. And then that actually became, this is when we were chatting with Josh earlier, that actually became a low here for the market that lasted for a couple months before the bear market actually made a new low there. And then zooming out and scrolling out, 2022, here we are. And then of course, eventually that new lows came in and we continued our bear market. But for pretty much 2 months that was an absolute low. So the only reason why I'm really bringing that up, it's the closest parallel to what we have going on right now. There's a lot of uncertainty. I definitely don't like these headlines going off on this, tit for tat that's happening, where it's like, Iran felt like they needed to do something to Israel that hopefully wasn't going to escalate it, but we have to because of our ego or whatever. And then Israel was like, well, that attack was too big, so now we need to potentially respond against you. And we saw some reports coming out saying that they are. And now Iran here vows to respond within seconds if Israel attacks again. These are not headlines that we want to see if you're trying to be bullish on the market. So just leading to a further continued sell-off on the uncertainty. But, in some ways, and I really hope I don't come off as being insensitive to any people, but in some ways, from my limited experience trading in these sorts of environments, it's the anticipation and it's the back and forth like we're seeing right now, the chatter back and forth that we're seeing right now, that from a market perspective tends to actually be worse than things actually happening to some degree. And that's exactly what we saw with the Ukraine and Russia situation, to the point now where, it's not like Russia and Ukraine has been resolved, but when's the last time we saw like a real Russia or Ukraine headline actually move the market? Not at all. And I truly, truly hope that this Iran and Israel thing doesn't turn out to be a drawn out, protracted, hot war like is occurring over there, and I'm inclined to think that it won't. But I do think that what we've seen historically is that from a market's perspective, the bark is almost worse than the bite. So seeing this continued language back and forth creates enough uncertainty that creates selling. And what we also know is that selling leads to more selling in this environment. Number one, you've got funds out there that de-risk based on the VIX. So that VIX moves higher, volatility becomes higher, uncertainty becomes higher, and they're automatically deleveraging. And then, one thing can just kind of lead to the next. And this is what we talk about feedback cycles of selling. And we're not at what seems like to be the major CTA trigger yet. It's been very deep and very far away because they've been in the money by so much. But it can just start with, systematic selling coming into the market because the VIX is high. That leads to a break of some of these support levels. Again, I still think that this 503 that we're almost at is extremely important. It leads to a break of some of those support levels. And then eventually you get more to your CTA triggers and your trend systematic flow triggers, and selling leads to more selling. And that's how you get, a 10% correction in the market, which again is eventually probably viable. But that's where we're at. And as of today, that we also got through, I think, the last day of selling for the IRS around that seasonality. So we'll see if that can help support the market a little bit also. But, we're in an interesting time because we're coming into options expiration this week, which can create that window of weakness. And I think that I'd be curious to know where gamma flips short, if there's an SPX level for that, or if we've already broken that. I haven't seen any updates on those numbers, because if gamma has flipped short on top of it, that could even further exacerbate the downside selling that comes in. So we're in an interesting environment today. I thought pre-market, we were getting very mixed signals pre-market, because when we first kind of woke up, it seemed like maybe this was going to be all resolved already by the end of today. And we saw the SPYs gapping up really big this morning. They were potentially set to negate Friday's high, which would have been extremely bullish technically if that could have happened. You had the Qs, same deal, getting right to Friday's high. So the SPYs of the Qs seemed relatively bullish to me if they could have held their gap ups this morning, which obviously they didn't. But the IWM we discussed in the morning meeting today actually looked bearish and technically looked like something that you could short into. Because even though the Russell was gapping up this morning, it was only gapping up a percentage of Friday's move, and the TLT was getting slaughtered pre-market this morning. So interest rates are higher. That creates relative weakness in the IWM, and 200 is such a big level, and we were gapping into 200. So I remember pre-market thinking like, hey, if SPYs and Qs can hold their gap this morning, they look like longs to me. But the IWM, this gap up into 200 bucks, that actually looks like a short. So there was some mixed signals there. So I do hope that people were able to take advantage a little bit to the downside today. I thought it was kind of tricky because of those mixed signals. But, I mean, the Tesla short call out this morning, if anybody took that, was definitely all you needed. The inside and down off the layoff news, as we discussed in the morning meeting, you could have gotten in this trade for pretty low risk. Yeah, you could have gotten this thing if you're just paying attention to it off the open for like 40 cents worth of risk in Tesla, and it would have paid you $9 worth of reward almost, including this little bit of an after hours move right now. So that was really the money trade, and everything else was based on the if then statements of if the market can hold up, if we can hold that gap, then Nvidia looks pretty good. And guess what? Nvidia was really good this morning, really good until the market caused it to fail. If the market holds up, you can look at Microsoft for a potential long above 425. If the market holds up, then you can look at Meta for a long above 520. I stand by all three of those long trade ideas. You just have to go with that if-then statement, because guess what? The market did not hold up, and we had, again, I felt mixed signals from the market this morning where SPYs and Qs, if they could have just held that gap up, were looking great, whereas the IWM was still really concerning. The Russell at this point is down about 7%, I think, on the month. And we're just a couple weeks in. I think that this is showing a lot more of the damage of the real market. It's just interesting also, though, because when, you know, the Russell's going to sell most on Fed fears, and I actually think it's the Qs that are going to sell most on geopolitical fears. And that's kind of what we've seen even on the intraday price action. Where did we close today? What did I say? SPYs are down 1.3. Qs are down 1.7, and the IWM is down 1.6. The IWM is actually down less than the Qs are today. And the reason for that is because really this like second half of the day selling that was coming into the market was more on the geopolitical stuff. And I remember watching that sell-off. I think we were even looking for like a bounce long maybe here at 130 after they wrecked this market down. And the Qs were weaker there than the IWM was. This became a low here at 130 for the Russell for pretty much an hour, or even more if this low held an hour and a half maybe. Whereas the Qs at that point were regaining relative weakness because the story in the market at the open that was creating the weakness was more on the interest rates, which was why I was surprised that the IWM even tested this 200 to begin with, given where the TLT was. TLT smoked this morning, interest rates higher, IWM is going to be relatively weak. That story started to change in the second half of the day. The TLT never really rallied on the fear trade like we've seen in the past, but it was able to hold in and at least go sideways, which then I think actually changed to the IWM holding in better in the heavy selling portion on the geopolitical fears, which were the second half of the day, whereas the Qs, we just look at this sell-off here in the Qs at 10 after 1 versus the sell-off here in the IWM. You can just tell by eyeballing it that it was much less extreme for the Russell than it was for the Qs. There's a lot more money, I think, in a fear trade available to come out of the market in the big cap tech stocks. It's also the more expensive part of the market. So I think when people are rushing to raise cash or whatever because they're fearful that you're going to see heavier QQQ selling. And the IWM should hold up better because the same fear trade will make the TLT move up. TLT moving higher is actually going to bring your interest rates down a little bit, which will also help the IWM by a little bit also. So that's just kind of the environment, and we want to pay attention to that intraday, because I remember when we had this big sell-off happening after 1 o'clock, and we talked, even though it didn't really work, about looking for like this oversold bounce trade here at 130. I really think that when you're taking that trade and you understand the circumstance of what's causing that sell-off, that you want to be doing it more in the IWM or the TNA as a levered ETF than doing it in the Qs. Even if big picture in the daily chart, the Qs are still stronger. So I think that that's something to keep in mind as well. So that's pretty much all I got. I'm happy to take a look at what you guys have. Bill giving me some information on our positive negative gamma flip trigger. I found that each strike for a dealer is different, leaving them having a positive negative gamma per strike. So I don't really talk about this one anymore. Gotcha. Let's take a look anyway. Gex flip 5214. I feel like I read a note somewhere today, Bill, maybe it was Charlie's note, that said that it seemed like, based on, and I kind of skimmed it, that it had already flipped to negative. And based on your first chart there, it seems like that might be confirmed, at least based on that one. I'm seeing that this dealer's gamma exposure surface chart is kind of wild looking how they have this built out. But you can see that drop down there, 50-50. Where did we close on an SPX basis? 50-60. Pretty much into that drop zone. Thanks, Bill. Yeah, so that obviously can further lead to selling to more selling. Thanks, Bill. Let me scroll up a little higher, just see if I missed anything. Austin here, I think, actually given a pretty good comment when you say that all this posturing is making me nervous. I wish they would stop it already. Yeah, and I agree with you, and it's making the whole market nervous, and that's the whole point that I'm trying to get across, where, you know, again, not trying to be insensitive to the actual situation that's occurring, or people who might be affected by it. But from a market's perspective, the bark can oftentimes be even worse than the bite, just because it's all the posturing and the chatter that makes everyone, like you're saying, nervous and fearful. That leads to even more selling sometimes than when, again, just using the Russia-Ukraine situation as an example, they sold that market heavily for like 5 days, knowing that it was coming and all the chatter and everything, and oh my God, what's going to happen? And then the invasion happens, we gap down huge, and we get bought up all day. So that's kind of what I meant by that. And I think your comment is the exact, almost psychological reason why it occurs. From Cameron, are you looking at your overextension rules any differently with CTA flows being more aggressively on the downside? No, not necessarily. It's just more. It's just more that if we're at those levels where that selling should come in, that the bounces become much more shortable once you're not in extreme extension. I'm still not going to want to short a market that has short-term tactical in the green plus $10 of extension. I'm not going to want to do that. But I'm much more. I think there's a lot more potential to shorting the bounces on those days. Or when you go from $12 extended and you get a bounce, and at the same time the moving averages are moving down, and now we're $4 of extended or $5 extended to the downside. Whereas I might typically call that more no man's land. Maybe I want to be more aggressive into shorting that bounce. Is really more kind of the thought process. Still not a fan of chasing price, Occasionally it can pay because momentum can be a heck of a thing, but in the long run, I think it sets you up for much worse risk-reward and probability of success situations. Thanks for the question, Cameron. Popping over to the YouTube here to see what we got going on. Ooh, a bunch of comments and questions. Let's have a look. In the meantime, if anybody else has anything in the VTF, feel free to post. From Joy, do we think that FedEx and DXYZ are good shorts? Of course, with limited risk, like a day trade or using options. Very different products. So we can start with FedEx. FedEx has almost filled its gap, so it just does not look like a good short to me here. This big gap, I don't remember what this was from. I assume earnings that sold all the way down now to fill the gap here at 265 as the market's becoming super extended. I prefer this as a long to a short. If we can get the market to gap down and hit that $10 plus of extension where you want to look for longs, this gap fill could be a great potential support zone to go long. And then this DXYZ, I know you're specifically mentioning trying to limit your risk. If you want to limit your risk, you probably don't want to trade this product. This thing's insane. Ripped from $22 to $105 in 4 days, and then went from $105 to $29 in 4 days inside day to day. I'd be very careful with this. I actually prefer it as a long to a short as you get into these $20, $30 price levels. At $100, it seemed stupid expensive, but it was also one of those situations and one of those names, especially with being like a recent ETF, where I just have the fear if I'm trying to short this at 100 that it goes to 500 before the blow off actually occurs because it's unreasonably priced. So I didn't want to be involved in it up there. But at these prices, I almost prefer it long to short. A great follow-up question from Joy on our conversation about geopolitics and the TLT. The question is, if today's decline is again related to geopolitics, why is the TLT not up like it was on last Friday? I think that there was already a lot of structural damage that was happening to this TLT today that was creating this heavy decline. And if anything, I think that if it wasn't for a fear trade coming in the second half of the day that led to the equity selling, that this TLT actually would have continued its sell-off throughout the day today. I think that they were wrecking this thing in the morning, and even though it's extended to the downside, I don't think that they were going to stop selling this thing, but I think an underlying bid actually held it up in the face of that selling that created more sideways price action than anything else. Otherwise, I do think it would have bounced further. So pretty much my answer to you is that I think that this thing would have sold off significantly more if it wasn't for all of the global issues that we're having right now. From Kevin G, are you going to be watching bank earnings for the IWM, or do you think there'll be a weaker factor until the geopolitical news is resolved? I am definitely watching the bank earnings. I thought that Goldman's report was great this morning. I thought it was the best of the big banks that have reported so far. I think that, JP Morgan had a decent report outside of the net interest income number, which is probably the most important number for some of these banks now. So I think that JP Morgan is potentially viable at a certain point on big dips. I like it at 180. The IWM is going to move more with these KRE earnings than it is with these XLF earnings. So yeah, $46 is a support level to watch here with the KRE. But I think that we're in an environment now where the macro is really important, or at least it was today. It's interesting because that's going to be happening at the same time as we're about to get all these really big earnings reports that hit. So hope that helps Kevin. From Turbine, because the bond sell for TLT may have caused or magnified the sell-off. Yeah. From Gabriel, do you like XBI for an RDR tomorrow this week? Valuation-wise, biotech is not expensive. And neither is the IWM, which is also why I kind of like the areas, but you got to watch interest rates because XBI, this biotech ETF, is very interest rate sensitive also. So if this TLT continues this decline, especially this very rapid rate of decline, then it's going to be really tough to be long the IWM. It's going to be really tough to be long the XBI. Josh was chattering at some point today. I don't know what price, probably 86, at potentially looking at an XBI long. And I do like that $86 level even as I look at it. I like the idea of looking for a bounce trade in this. Just again, just keep in mind you really got to be watching interest rates with this, and interest rates have certainly been moving up. The U.S. bond should be one of the safe havens during a geopolitical risk, which will push the bond and TLT higher, but today we didn't see it. Yeah, I kind of already answered that one a little bit. Yeah, and I agree. So, I mean, I generally agree with your other statement here, Joy, where you're saying war is a short-term cloud on top of the Qs and large caps, while inflation and interest rates are mid to longer-term clouds for the IWM and the XBI. So we should expect the large caps to rebound sooner. It's hard to say the timing on that. I think that your thought process is generally right, though. Whereas the war situation getting worse or better will have more of an effect on the Qs, and the interest rate situation getting worse or better will have more of an effect on the IWM. So I do generally agree with the statement. I'm just not necessarily sure on timing. Because while we certainly think and hope that this war situation is a short-term situation, it could escalate into something more, it could escalate into something bigger, which I certainly hope that does not happen. And at the same time, it still seems like Powell and the Fed, despite the retail sales number this morning and the CPI and everything else, are fairly intent on staying with that language of easing. So it's going to be interesting to see how the market plays out on that one. Cool. Back over to the VTF. From Rich, how shall we overcome the psychological dilemma of making money while trading off wartime pain and suffering? Oh, man. So, I mean, I think you have to have a degree of compartmentalization and separation with trading in general. And I mean that in a number of ways. I can speak pretty broadly. I know that like a super big mistake that traders can make is to allow their political affiliation to, and this is a little bit different of an example based on what you're saying, to allow their political affiliation to affect the way that they trade or the markets or whatever, to say, oh my gosh, so-and-so is president, therefore the market is going to go to zero and go down. When, I mean, you can just use the last two presidents as an example, Trump and Biden. I'm not going to give any political opinion on either of them as I say this, but we saw a whole lot of new all-time highs over the course of the presidency of both of them, right? And if you are on one side of one camp because you're so deep into politics that you think it has to be the end of the world because somebody becomes president, then, you know, historically, that's just going to cost you a lot of money. And I think it's the same thing as well. You know, our job is to be a trader. So, you know, obviously war is, very broadly speaking, not a good thing ever. That type of pain and suffering is not good ever. But we still have to do our jobs. And, you know, if it ever makes you feel better or whatever, if you want, because you made a ton of money off of, for example, buying the Russian invasion of Ukraine, then you could, you know, make a donation of a percentage of your profits to some sort of certain cause or whatever that maybe can help relieve some of the pain or suffering that's out there of a percentage of your P&L. That's just an idea. We need to continue to do our jobs. From David L. Can you talk a little bit about keeping track of a variety of trade ideas at the open? I do put out alerts. However, sometimes with multiple alerts going off at the same time, I tend to get more distracted than trying to switch over to trade it. Do you put out multiple orders ahead of time in the pre-market to get ready for a trade? Sometimes. Tesla, for example, today, I did have an alert, but I was focusing on other stocks at the open and I missed the trade. I feel like I should have just had an order out and managed it if it got filled. Still gaining experience managing multiple trade ideas, but if you share a few thoughts on that. Sure. The first thing I want to let you know is that it's impossible to catch every trade. Even every trade that you research, I think it's impossible to catch all of them, and you have to learn to be okay with missing out on trades. Tesla was like my favorite idea this morning, and guess what? I missed it too. Just too much on my plate right now. So first of all, is just you need to just accept that you're not going to be able to capture every single trade all the time. With that said, of course, we want to maximize the amount of opportunities that we are able to capture. One way to do that is potentially a system of alerts, like you're saying, though that's definitely not perfect either. It happens to me all. I wouldn't say that I ever get distracted by my alerts. I would say that just sometimes I see these alerts popping up on one of my monitors here, and I more or less ignore them because I more or less ignore them because I've just got too much on my plate and I can't type over to that stock at that time. Another thing that I will sometimes do is have some orders out, but you gotta be a little bit careful with that. I prefer to have just outstanding orders for positions that I'm already in. I'm already in the position, therefore I already have a game plan, so I want to have my orders out for the game plan that I already have, as opposed to just throwing out orders while you're not watching it. Can be a little bit dangerous. What I prefer to do, probably more than anything, if it's a really important trade to me and I'm afraid of missing it, is just to get myself involved with like a smaller feeler position, even if it's not at my trigger price. And sometimes that does cost me. I'll jump into something a little bit early, even though it hasn't hit my trigger price, just because I know that I'm probably not going to miss my trigger price if I have the feeler on. But again, if that feeler moves against me, I might basically be wasting some money. If it moves in my favor, I might make more than I would have made otherwise. But I know that once it's actually on my screen as a position, then 19 times out of 20, I'm going to be trading it properly going from that moment forward, and I'm not going to miss it. So if I sometimes really, really like something like Tesla short as an example today, then maybe I'll just whack a little bit pre-market, get it on my books, and then once I know it's on my books, I know I'm going to be focused on it because it's a top idea of mine. So I hope that helps, David. Thank you for the question. From Austin. I know we went over this already, so I apologize, but when you're doing a swing trade with the trend, do you trail your stops on a 5-minute time frame all day, or do you switch? If it's a swing trade that I've already kept overnight, I pretty much will only trail on the daily chart. If you trailed something on the 5-minute today and it closed well and you keep it overnight, just to trail it again on the 5-minute tomorrow, you might as well not even take the risk of keeping it overnight. You're going to get stopped out so fast. I think that it's only worth swinging positions if you've got such a large profit cushion and you're in such a win-win situation that it makes sense to give that percentage of the position that you still have on all the way back to initially your original stop loss, meaning you are willing to give back every bit of open P&L that you have on what you kept overnight until you have the opportunity to actually swing it on a daily chart. And then maybe next thing you know, that could be a multi-day, week, or month hold. Otherwise, I don't think the risk reward is worth it to trail on the smaller time frames after day one. Thanks, Austin. All right, cool. Looks like I got through everything in the VTF and everything in YouTube. I hope you guys had a decent day today. I hope you guys were able to take advantage of the downside or at least not get caught off guard by it. I thought that the open was a little bit tricky just with the way we were gapping and some of those mixed signals. But yeah, so let's see what happens tomorrow. I'm almost hoping for that big gap down tomorrow because I think it'll make a better buying opportunity. But let's there's so much going on right now that we got to take it as it comes. So let's assess things in the morning. Have a great night, everybody. I'll see you then.